Have you ever wondered if there is a path to consistent, predictable monthly income without working a regular job? What if I told you it is possible to earn $3,000 every single month purely from your investments? Surprising, yes, but it is also within reach. You only need the right strategies and the right stocks. Stay with me, and I will show you exactly how dividend aristocrats can help you reach that goal faster than you ever imagined. Missing out on this information could mean missing your chance at genuine financial freedom, so stick around until the very end. Welcome to this special video where we explore the powerful investment strategy of dividend aristocrats, a select group of companies known for increasing their dividends annually for at least 25 years. Imagine earning $3,000 monthly, just from dividends. Stay tuned as we uncover which aristocrats might fit your investment strategy, how their reliable dividend yields can help accelerate your financial goals, and the initial steps you need to start investing. We will map out potential growth scenarios over 1 year, 5 years, 10 years, and even 30 years. I have extensively studied the history of these iconic dividend-paying companies, and I am excited to guide you through what could be your biggest step toward financial independence. Before we delve into the details, let's consider a real-life scenario that illustrates the power of investing in dividend aristocrats. Imagine a teacher named Jane Doe from Texas. 5 years ago, Jane started investing with an initial amount of $10,000 and added monthly contributions of $500. Focusing on pillars like Johnson & Johnson and Coca-Cola, today, her portfolio generates over $1,000 per month solely from dividends. Jane shares, "Starting with dividend aristocrats was the best decision for my financial future. The stability and consistent growth in dividends have not only boosted my investment confidence, but have also provided a significant supplement to my income." Jane's dividends grew steadily, thanks to consistent reinvestment and dividend increases from these robust companies. Now that you've seen what can be achieved, keep watching because we will dive into the specifics. First things first, what are dividend aristocrats? Dividend aristocrats are companies in the S&P 500 index that have consistently increased their dividend payouts for at least 25 consecutive years. When you purchase shares of a dividend aristocrat, you are not simply investing in a random stock. You are partnering with businesses that have weathered recessions, market crashes, and ever-changing consumer trends, all while raising the amount of money they pay you. Does that sound appealing? Some prominent dividend aristocrats include Coca-Cola, Johnson & Johnson, 3M, and Target. Their annual yields vary, often in the ballpark of 2% to 4%. Although that may not seem super high at first glance, keep in mind that these companies have a rich history of boosting their payouts year after year. That means your yield on cost can steadily climb over time. Why is this important? Because consistent dividend increases create a powerful compounding effect. Each time the dividend goes up, you can reinvest that extra cash into more shares. Eventually, you can switch off reinvestment and start collecting monthly checks that pay your bills. We are talking about aiming for $3,000 per month. Yes, that is $36,000 per year, just from dividends. Now, let us turn our focus to a few specific dividend aristocrats and the yields they often provide. To help you see how this can work, let us spotlight 3 dividend aristocrats with a track record for stable dividend growth. Coca-Cola, ticker symbol KO, usually offers a yield around 3%. This iconic beverage company has been growing its dividend for over 5 consecutive decades. Their business might not grow explosively, but it is steady and global, ensuring consistent cash flow. Next, consider Johnson & Johnson, ticker symbol JNJ. Their yield generally falls between 2% and 3%. This healthcare giant has expanded its dividend for many consecutive years, and it benefits from a broad product portfolio spanning medical devices, pharmaceuticals, and consumer goods. Then there is 3M, ticker symbol MMM, another dividend aristocrat that tends to yield roughly 3% to 4%. Known for products like Post-it notes and a wide array of industrial solutions, 3M remains deeply diversified. They have raised dividends for multiple decades straight. You may be thinking, 3 or 4% is not enormous. However, as these companies consistently raise dividends, your initial yield can transform into something larger over time. And if your goal is to hit that $3,000 monthly figure, do not worry. We will talk about how to accelerate the process. Let us jump straight to the big question. How much do you need to invest to get $3,000 each month in dividends from dividend aristocrats? Because the average yield among them might hover around 3%, You would typically need around $1,200,000 to net $36,000 per year at that yield. 3% of $1,200,000 equals $36,000. That number might look huge if you're just starting out, but don't worry. We are going to break down how to scale up to this level over different time frames, because remember, the dividend growth factor can substantially reduce the amount of money you need if you invest and reinvest over the long run. Also, you can blend higher yield dividend aristocrats with moderate yield ones, or you can complement them with certain exchange-traded funds, also called ETFs, to raise your overall yield a bit higher. For instance, some investors add a smaller allocation to a high dividend ETF, such as the Vanguard High Dividend Yield ETF, ticker symbol VYM, which can yield around 3 to 4%, or the Schwab US Dividend Equity ETF, ticker symbol SCHD, often also in the 3 to 4% zone. This can push your portfolio yield upward while keeping you diversified in stable companies. Let us talk about year 1. If you are new to dividend investing, your focus is simple. Get started. Pick 1 or 2 dividend aristocrats that you understand and believe in, then set up an automatic monthly deposit into your brokerage. Let us say you can contribute $500 each month. That means in 1 year, you will have contributed $6,000, ignoring any price growth. If the average yield is around 3%, your dividends from that $6,000 would be about $180 per year. That is not enough to pay your rent, but it is the seed of your dividend empire. Also, keep in mind that many of these companies may boost their dividends during this year, slightly upping your payout. And if you drip your dividends, meaning you reinvest them, you are already compounding. Now let us look at 5 years. If you keep contributing $500 monthly, that totals $30,000 in principal contributions over 5 years. But if your companies grow, and you are reinvesting dividends, you might be sitting on a portfolio valued higher than that $30,000. Let us assume the yield remains around 3%. You could be earning close to $900 annually in dividends. Plus, there is a decent chance your dividend aristocrats have been increasing their payouts, so your effective yield might be higher than 3% over your original investment. Although $900 per year is not massive, it is a healthy chunk of money that can keep growing if you stay disciplined. Fast forward to 10 years, still contributing $500 a month. That is $60,000 in total contributions. Again, if you factor in modest capital gains and dividend reinvestments, your portfolio might be worth something above $60,000, maybe $70,000, $80,000, or more, depending on the market. At a 3% yield, you might be pulling in over $2,000 per year in dividends. This could pay a few of your monthly bills. Remember, each time an aristocrat raises its dividend, your yield on cost climbs. Over a decade, these increases can be substantial, leading to more significant payouts than you might expect. Finally, the big horizon, 30 years. This is where dividend growth becomes truly magical. With consistent contributions, reinvestment, and rising dividends, your portfolio could reasonably surpass $500,000 or even $1 million, depending on how much you increase your monthly deposits over time, what the market does, and how fast the dividends grow. At a portfolio size of, for example, $800,000 or $1 million, a yield near 3% could give you $24,000 or $30,000 annually. Add in dividend growth, and you are creeping ever closer to that $3,000 monthly. For those who manage to build a 7-figure sum, crossing that $3,000 monthly mark is entirely possible. And if you surpass $1 million, you might be aiming for $4,000 or $5,000 a month in dividends. Let us consider ways to speed things up. First, contribute more than $500 a month if you can. Every extra dollar you invest raises your eventual dividend stream. Second, aim to select dividend aristocrats with slightly above average yields. Some aristocrats occasionally trade at prices that offer yields around 4%. Take advantage of market dips, which can push yields higher while giving you more shares for your money. Third, if you are comfortable, allocate a portion of your portfolio to higher dividend ETFs. This can boost your overall yield, but keep track of the risks. Fourth, stay mindful of each company's fundamentals and payout history. Aristocrats are known for stability, but it is always wise to monitor their earnings trends and management guidance. Let us bring this to life with a quick scenario. Imagine you split your monthly contributions between Coca-Cola and 3M. Coca-Cola has a yield around 3%, while 3M might be closer to 4%. Your blended yield is about 3.5%. Over a decade, both companies likely raise their dividends consistently, bumping your effective yield. Meanwhile, you reinvest every payout. If you start with no money and put in $1,000 per month, after 10 years, you might see a six-figure portfolio, generating several $1,000s a year in dividends. And after 30 years, that number can become large enough to comfortably fund a portion of your retirement, or even push you to fully retire on dividends alone. Now, let us look at whether you should focus on picking individual dividend aristocrats, or should you buy a dividend-centric ETF that holds many aristocrats at once? For example, the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL, aims to track dividend aristocrats and typically yields around 2%. While that may be lower than hand-picking higher-yield aristocrats, you gain instant diversification. Another possibility is the Vanguard Dividend Appreciation ETF, ticker symbol VIG, which focuses on companies with a solid record of increasing dividends. Its yield may also hover around 2%, but it includes some dividend aristocrats. If you prefer simplicity and broad coverage, an ETF might be your best route. If you enjoy researching individual companies, you may prefer building your own basket of aristocrats. The essential keys to success with dividend aristocrats revolve around patience, consistency, and reinvestment. Focus on companies or ETFs that have proven track records of annual dividend hikes. Deposit money into your portfolio regularly. Do not try to time the market. Reinvest every dividend until you hit your target. Also remember to consider speaking to a professional if you need personalized guidance. Finally, focus on the long term. Even if your first-year dividends look small, do not be discouraged. The real magic of dividend growth unfolds over many years. We have covered a lot today: what dividend aristocrats are, why they are so reliable, how you can build a portfolio that aims for $3,000 a month, and how these dividends might grow in 1 year, 5 years, 10 years, or even 30 years. Remember, it is all about staying consistent and letting time do the heavy lifting for you. This could be your roadmap to a future where your bills are handled by dividends, leaving you free to spend your time as you please. You might also want to consult someone knowledgeable for taxes if you have specific concerns. Now, I want to keep delivering value. If you are ready for the next step and want more strategies to boost your passive income, watch the video you will see on your screen right now. It is jam-packed with tips,